Welcome to our series on advanced tax strategies for estate planning. In this fifth video, we dive into the complexities of international estate planning and tax considerations. If you have assets or beneficiaries in multiple countries, understanding the intricate web of international estate tax laws is essential. We'll cover key topics like residency and domicile, tax treaties, and strategies to minimize tax liabilities across borders. Whether you're planning to transfer wealth to heirs or simply protect your international assets, this video will provide valuable insights to help you navigate the challenges of cross-border estate planning. Let's get started. Understanding international estate tax laws. Understanding international estate tax laws is crucial for effective estate planning, especially for individuals with assets or beneficiaries in multiple countries. International estate tax laws can be complex and vary significantly from one country to another, making it essential to seek professional advice to navigate these complexities. Here are some key points to consider when dealing with international estate tax laws. 1. Residency and domicile. Different countries have different rules regarding residency and domicile for estate tax purposes. It's important to understand the criteria used by each country to determine an individual's tax residency status, as this can have a significant impact on the taxation of their worldwide assets upon death. 2. Tax treaties. Many countries have tax treaties in place to prevent double taxation on estates with assets in multiple jurisdictions. These treaties often provide rules for determining which country has the primary right to tax the estate and specify the mechanisms for providing relief from double taxation. Estate tax thresholds and rates. Estate tax thresholds and rates can vary greatly between countries. Some countries have high thresholds before estate tax is imposed, while others have lower thresholds with higher tax rates. Understanding these thresholds and rates is essential for proper estate planning to minimize tax liabilities. Gift and inheritance taxes. In addition to estate taxes, some countries also have gift and inheritance taxes that apply to transfers of wealth during an individual's lifetime or upon their death. It's important to consider these taxes when developing an international estate plan to ensure compliance and minimize tax liabilities. 5. Foreign account reporting. Individuals with assets in foreign countries may also have reporting obligations with their home country's tax authorities. Failure to comply with these reporting requirements can result in penalties and additional tax liabilities. Understanding and fulfilling these reporting obligations is essential for a comprehensive international estate plan. 2. Estate planning strategies. Given the complexities of international estate tax laws, engaging in strategic estate planning is crucial. This may involve setting up trusts, gifting assets, or utilizing other tax-efficient structures to minimize estate tax liabilities in multiple jurisdictions. Working with experts in international tax law and estate planning can help individuals navigate these complexities and develop a tailored plan that meets their objectives. Understanding international estate tax laws is essential for effective estate planning when dealing with assets and beneficiaries in multiple countries. Seeking professional advice and staying informed about the relevant laws and regulations can help individuals navigate the complexities of international estate taxation and minimize tax liabilities across jurisdictions. Planning for cross-border estates. Estate planning for individuals with assets in multiple countries presents unique challenges and opportunities. Cross-border estates are subject to complex tax laws and regulations, which can impact the distribution of assets and the overall estate plan. To effectively plan for cross-border estates, it is crucial to consider the following key aspects. 1. Jurisdictional considerations. Identify all countries where the individual holds assets or has residency status. Understand the tax laws and regulations in each jurisdiction regarding estate planning, inheritance, and gift taxes. 2. Consider any international treaties or agreements that may affect the taxation of cross-border estates. 2. Tax implications. Determine potential tax liabilities in each jurisdiction, including estate taxes, inheritance taxes, and gift taxes. Explore opportunities to minimize tax exposure through strategic estate planning techniques, such as trusts, gifting strategies, and asset structuring. Consider the impact of currency exchange rates on the value of assets and tax obligations. Coordination of legal documents. Ensure that legal documents such as wills, trusts, and powers of attorney comply with the laws of each relevant jurisdiction. Coordinate with legal advisors in each country to establish a comprehensive estate plan that addresses all cross-border considerations. Consider the implications of different legal systems on the administration and distribution of assets in cross-border estates. 4. Succession planning. Plan for the transfer of assets across borders in a tax-efficient manner to preserve wealth for future generations. 2. Consider the implications of forced heirship rules in certain jurisdictions, which may limit the testator's freedom to dispose of assets. Establish clear guidelines for the management and distribution of assets to ensure a smooth transition of wealth to heirs. 5. Compliance and reporting requirements. Be aware of reporting obligations in each jurisdiction, including disclosure requirements for foreign assets and income. Comply with anti-money laundering regulations and other legal requirements when transferring assets internationally. Seek guidance from tax professionals and legal advisors to ensure full compliance with cross-border estate planning regulations. Planning for cross-border estates requires a comprehensive understanding of the legal, tax, and regulatory considerations in multiple jurisdictions. By proactively addressing these complexities and implementing tailored strategies, individuals can effectively manage their cross-border estates and preserve wealth for future generations. Tax implications of foreign assets in estate planning. When it comes to estate planning involving foreign assets, individuals need to be aware of the various tax implications that may arise. Foreign assets can encompass a wide range of properties, including real estate, bank accounts, investments, and business interests located outside the individual's home country. Here are some key considerations regarding the tax implications of foreign assets in estate planning. 1. Residency and domicile. One of the primary factors that determine the tax treatment of foreign assets is the individual's residency and domicile status. Different countries have their own rules regarding taxation based on residency or domicile, and individuals may be subject to tax in multiple jurisdictions. 2. Tax treaties. Many countries have tax treaties in place to prevent double taxation on the same income or assets. It is essential to understand the provisions of any relevant tax treaties between the individual's home country and the country where the foreign assets are located. Estate taxes. Some countries impose estate or inheritance taxes on assets located within their jurisdiction, regardless of the deceased individual's residency status. It is crucial to consider these potential taxes when planning the distribution of foreign assets to beneficiaries. 4. Reporting requirements. Individuals with foreign assets may be required to comply with additional reporting requirements, such as disclosing foreign bank accounts or investments to tax authorities. Failure to fulfill these obligations can result in penalties or legal consequences. 5. Currency exchange. Fluctuations in exchange rates can impact the value of foreign assets and the potential tax liabilities associated with them. It is important to consider currency exchange risks when evaluating the overall estate plan. Gifting strategies. Transferring foreign assets as gifts during one's lifetime can have tax implications for both the donor and the recipient. Understanding the gift tax rules in the relevant jurisdictions is essential when incorporating gifting strategies into estate planning. 7. Estate planning tools. Various estate planning tools, such as trusts or offshore entities, can be utilized to manage and protect foreign assets efficiently. These tools can help minimize tax liabilities, provide asset protection, and facilitate the smooth transfer of assets to beneficiaries. Navigating the tax implications of foreign assets in estate planning requires careful consideration of residency status, tax treaties, estate taxes, reporting requirements, currency exchange risks, gifting strategies, and estate planning tools. Seeking advice from tax professionals and estate planning experts with experience in international matters can help individuals develop a comprehensive plan that optimizes tax efficiency and preserves wealth across multiple jurisdictions, utilizing treaties and strategies to minimize international estate taxes. International estate planning involves navigating complex tax laws and treaties to minimize tax liabilities on assets passing between countries. By employing advanced tax strategies and leveraging international treaties, individuals can effectively reduce their exposure to estate taxes and preserve wealth for future generations. 1. Understanding tax treaties. Many countries have established tax treaties with one another to prevent double taxation on assets passing between them. These treaties dictate how estate taxes will be assessed when a resident of one country passes away with assets located in another country. By understanding the provisions of these treaties, individuals can take advantage of potential tax credits or exemptions to minimize their overall tax burden. 2. Residency and domicile planning. Determining residency and domicile status is crucial in international estate planning. Residency determines where an individual is subject to tax, while domicile dictates an individual's permanent home for tax purposes. By strategically establishing residency and domicile in tax-friendly jurisdictions, individuals can potentially reduce their exposure to high estate taxes in their home country. Structuring ownership of foreign assets. Owning assets through certain legal structures, such as trusts or holding companies, can provide tax advantages in international estate planning. These structures can help mitigate estate tax liabilities by transferring ownership of assets in a tax-efficient manner, taking advantage of exemptions or lower tax rates available in specific jurisdictions. Gift and inheritance tax planning. Leveraging gift and inheritance tax laws in different countries can be a powerful strategy to minimize estate taxes. By making strategic gifts during one's lifetime, or structuring inheritances in a tax-efficient manner, individuals can transfer wealth to heirs while minimizing tax liabilities both domestically and internationally. 5. Estate freeze techniques. Estate freeze techniques involve transferring the future growth of assets to the next generation while retaining control over the initial value of those assets. By utilizing these strategies, individuals can effectively reduce the value of their taxable estate and minimize estate tax obligations, especially when dealing with international assets subject to multiple tax jurisdictions. Effective international estate planning requires a comprehensive understanding of tax laws, treaties, and advanced strategies to minimize estate taxes across borders. By utilizing these tools and techniques, individuals can preserve their wealth, protect their legacies, and ensure a smooth transfer of assets to future generations in a tax-efficient manner.